exemption from estate and gift tax for each individual. The maximum estate and gift tax rate under the current law is 35%. This $5 million exemption also extends to the generation skipping tax for each individual. The 2010 Act represented a change from the prior law in that it reunified the estate and gift tax system, basically providing the same lifetime exemption for gifting as well as for the estate purposes. One unique feature with respect to the 2010 Act is the portability of the unused exemption from a deceased spouse for estate tax purposes. Essentially what this means is that to the extent you have a married couple who they can fully take advantage of their $10 million exemption, even if one spouse's estate is not fully funded to take advantage of their $5 million exemption. Any unused portion of that carries forward and can be used by the second spouse to reach that total of $10 million worth of untaxed assets. There are some negative impacts or some negative aspects to the current law. Obviously, the biggest one, and what we're really here to talk about today, is the fact that these provisions sunset at the end of the year. So, without any action by Congress, we're going to revert to the prior law, which basically means that we go back to a $1 million exemption amount and a maximum tax rate of 55%. One issue that's also been, an active matter of debate in the estate tax community relates to how estate tax will be calculated and what impact any change in the tax law going forward may have for those individuals who take advantage of the current $5 million exemption and 35% rate. It's unclear, as the law is currently drafted, as to whether or not the tax will be calculated based on a date of death or a date of gift value. And when I say the tax will be calculated, it's important to understand that the estate tax system basically, it taxes your lifetime gifts. It's a unified tax. So when we calculate the tax on the estate tax return, we take into consideration all the gifts that have previously been made and essentially pull those back into the estate for valuation purposes. A credit has been provided for estate tax or gift taxes that would have applied on those earlier gifts. Jay is going to talk a little bit more specifically about this kind of gap in the law and how it could possibly kind of diminish the impact of these beneficial rates.
Thanks, Eric. Let's talk about some of the proposals that are on the table and what we might see, hopefully, in the next few months.
Well, Brian, I think that I want to preface anything that we say here by saying that, kind of uncertainty is the only certainty that we have with respect to what's happening. There's a lot of debate going on right now about the whole fiscal cliff issue, and clearly estate tax is one element of that. The estate tax generally doesn't get as much attention because it applies to such a smaller or a limited number of taxpayers. Under the current law, only about 99.7% or 99.7% of estates are currently really exempt from any kind of estate tax. So there's basically four kind of proposals that, based on the intelligence that we read, that are floating around. Number one, we have a continuation of the existing law from the 2010 Act, that being the $5 million exemption, the 35% maximum tax rate. Obviously, if nothing is done by Congress and we sunset, we're going to go back to the $1 million exemption and that 55% maximum tax rate. The White House has floated a proposal that would set the exemption amount at $3.5 million, but raise the maximum tax rate to 45%. Obviously, there's a contingent of conservatives in the Congress that are also interested in investigating the repeal of the estate tax. Based on my best assumptions, I would say that we're probably looking at either a continuation of the existing law or some some form of the White House proposal. The cost that's associated with repeal is so great that to me, given the fiscal concerns, it's not likely that we're going to see that. Repeal has been scored at costing approximately $1.3 trillion over the next 10 years. That breaks down to over $1 trillion in actual revenue, and then around $277 billion in interest that would be paid on the additional debt that would be left due to the loss of revenue. Continuation of the existing law is somewhat more palatable in that it ends up costing around $6.9 billion or $609 billion over 10 years, $485,000 of that being lost revenue and the rest in interest. There's also been some discussion about maybe lowering the rate to 15% as opposed to 35 or 45%. My guess is that that's probably not going to be realistic either, because it doesn't dramatically reduce the cost of from repeal. In fact, it's going to cost roughly the same $1 trillion to set the rate at $1 trillion, or excuse me, set the rate at 15%. It's important to note in the debate, I think that the Congress is probably much more likely to focus on the rate as opposed to the exemption amount, because the rate realistically is where the real dollars are. Because such a small number of states are impacted, it's really the ultra affluent on the far end of the scale that really where this is the most has the most impact, and therefore that's why the rate has such a larger effect on the revenue.
Right, and I think, Eric, that one of the issues here, irrespective of whatever is ultimately decided in law, is that planning is really appropriate. And we're planning a little bit in a vacuum today. I liked your words that, there's no certainty with respect to the uncertainty. The thing that, when you think about it in political terms, that $5 million exemption is also indexed. Mm-hmm. For example, right now the exemption stands at $5,120,000. The White House proposal was floated in the Senate, and it was pulled back mm-hmm. in the Senate. Historically, when we've had changes in the estate tax law, typically I have never seen in 30-plus years where the exemption has been reduced from that which was mm-hmm. in place. These are a little bit of unusual times. While we're certainly going to talk about this as if we went back to the $1 million mm-hmm. exemption that existed pre the Bush tax legislation, but I would think that at the very least you're going to have a $3.5 million exemption going forward, and I think in all likelihood the exemption may be retained, albeit perhaps without the inflation adjustment. But I agree, the money's in the rate, mm-hmm. and it very well could be that the quid pro quo is we'll give you the exemption, we'll take 55% on whatever is taxable.
And Jay, I would totally agree with you that it's likely that, or it's unlikely that we're going to see complete sunset of these of the provisions, and I think mainly because that becomes so politically unpalatable. Currently, like I said, 99.7% of states are exempt. That means that about for 2012, roughly estimated that there's probably going to be about 3,600 states where the estate tax is going to be payable. If we see a sunset, that number jumps up to 55,200 states in 2013. I don't think anybody in Congress would be interested in seeing that kind of a change happen.
I agree. Although my other bet is that with so little time subsequent to the election and the inauguration of the new Congress and president, that I think it's going to be awfully hard. We could actually wind up with a sunset that would need to be addressed.
I think if that happens, and we've had that happen before, really, because that's really what happened with respect to the 2010, where we had no estate tax for 2010, and they went back and retroactively addressed that, providing the $5 million exemption amount.
That's why George Steinbrenner decided to die during 2010.
Yeah, it would be fortunate if your estate planning could be that effective.
So I guess our real planning thought would be that if you could time your death to to maximize the tax planning, that would be appropriate. It is sort of an extraordinary measure, a planning measure. We don't typically recommend it, but for those of you that are truly concerned with some adverse outcomes, this might be something to consider.
Yeah, the IRS doesn't provide a disclosure for that kind of advice. So, well, before we start too far down the road of some planning strategies, I do want to just get out on the table this clawback problem. So, Jay or Eric, do you want to kind of just fill us in a little bit more, understanding it may not be an issue?
Right. I think the clawback provision is something that a lot of people are potentially unaware of. And basically, this is the statute that really sort of refers to it. And once you get beyond the legalese and what might happen, here's the basic issue. Let's assume that someone makes a gift utilizing the full benefit of the estate tax exemption. And that would be the issue of someone making a $5,120,000 gift. And just for the sake of argument, we'll assume that the gift tax exemption, the estate tax exemption would revert back to $1 million next year. Because of this provision where you have the accumulated taxable gifts, that in theory and interpreted by many, that you could have literally a clawback for a decedent's estate where you take into account these gifts that were made without gift tax, but in essence increase the total value of the estate by these previously given amounts, and you could wind up with an extraordinary tax liability in the estate, principally because you've included into the estate gifts that were not previously taxed, but because the exemption was reduced, you have these amounts included in the total taxable estate, total gross estate. So my sense would be that there's some dispute about it. If I were to get into the minds of the drafters of the language, I would think that this was not really anticipated as being a problem, and there are certainly some people would argue that this was not the intent of Congress, that the drafting is too vague in terms of the technical terms and the references back to what are adjusted taxable gifts and what is the gift tax rate in the year of inclusion within the estate. These are technical issues. I would say that at the very least, if this clawback provision were to occur, where it could really adversely affect families, where in essence there may not be funds to pay the estate tax, where so much of the estate may have been given away, I think that's a real problem for Congress, and my guess is that you'd have some legislation, but it's out there as a potential issue, and it cannot be ignored in terms of the planning process.
Yeah, I would agree, Jay. I think it's important to point out that even if we're dealing with a clawback situation and we get the worst possible scenario with respect to that how that tax is calculated, although it will significantly diminish the value of making a current gift, there's still a clear benefit to making the current gift, not only from the aspect of getting any future appreciation out of your estate, but also just based on the straight-out calculation. And we'll cover that in an example that we're going to provide later on in the projection.
Right. And I think one thing that I think everyone should consider is that certainly that the estate tax law as is presently construed and is in all likelihood to be construed going forward, is this affects only a small number of taxpayers. But I think the important thing is that this is an area where there is very, very little planning. And I think so often what happens is that people are thinking about a transition in their lifetimes, but it becomes a crisis when there is an inadequate amount of time in which to plan. So while it may be an unpleasant and unpopular and I can do it tomorrow type of project, I think it behooves all of us to plan accordingly. The thing to keep in mind, and certainly in some of the discussion we'll have throughout the presentation, time is your friend. And if you use it to your advantage, there are strategies which will help your family to come up with the best outcome.
So speaking of time, we sit here at the end of September 2012. We've got about 3 full months to the end of the year. And Jeff, I'd like to get your insights too, but any three of you can start off. Let's talk about why gifting now makes sense, understanding some of the risks we already talked about.
Well, I mean, I think the clearest example in what we're talking about is the change in the law is that we have a potentially limited availability of the current exemption amount. You know, while we all agree that we're not going to see, it's unlikely that we'll see a sunset where we have the rate dropping back down to $1 million, I think it is likely that we may have a change somewhere between that $3.5 million and the $5 million number. And clearly, for the moderately sized taxable estate, that can make a huge impact on your ability to move assets out tax-free. You know, aside from the change in the law and the potential legal issues and the estate tax law issues, I think the current economic conditions also kind of really provide a tremendous opportunity. Although we're really starting to see some of the valuations, particularly in the real estate area, start to rebound to some extent, I think that we're still in a point where the valuation that we're able to achieve with respect to a closely held business interest or to real estate assets are such that there's really only room to move up from here. So in any estate tax planning scenario, getting that future appreciation out of your estate is a very valuable tool in maximizing the value of that lifetime exemption. And I think we're kind of at a historically low position, so it really makes sense, and all the indicators say now is the time to consider gifting. I think if you couple this with the historically low interest rates that we have right now, this really becomes kind of a perfect storm in terms of the giving opportunity. You know, these low interest rates have a huge impact, not only in that they provide you know, some beneficial lending capacity, so the cost of capital for funding an inter-family purchase or some other transaction is low, but it also has a really strong impact on the actuarial calculations that go into determining what an estate tax or a gift tax liability would be. We're going to cover that to some extent with some of the discussion that we'll provide later on in the example towards the end of the presentation.
So Jeff, what are some of your insights as a family business advisor?
Sure, certainly. Well, first, let me talk a little bit about goals and objectives. And I think that that's something that's really important to consider when thinking about what you might do in terms of changing estate planning. And first off, family business and family wealth, while you might think of those as two different things, I think that they're really very closely tied together, because what you're dealing with is you're dealing with financial capital of a family, whether it be a family who owns a family business or a family who has accumulated wealth or who may have sold the family business and has wealth as a result of that. And the reality is that when you're dealing with estate issues, you're really not talking about anything dramatically different between family business and family wealth. So I think we can actually kind of talk about them in the same context here to some degree. And also, what is wealth, and what's the definition of wealth? Because I don't want people to think that when we're talking about family businesses and family wealth that it's you know, 25 million, 50 million, 100 million. Family wealth is relative to a family circumstance, and really is what is it that enables you to have some level of financial freedom and the ability to do things that you wouldn't otherwise be able to do. So we're not talking about, you know, only families with significant dollars. It can be a family with a couple $1 million that can consider that family wealth, and what are they going to do with it, and there's some planning opportunities for them as well as those with $100 million and more. And so the goals and objectives really come in not so much at the family or at the financial level, but more at the what we'll call the human capital level. And let's talk about financial capital and human capital. And financial capital are the basic financial assets of the family, whether it's the business or the family wealth. And then the human capital is obviously the individuals that are involved, the family members that are involved. And the goals really center around those people, or at least in my view, probably should center around the human capital in the equation as opposed to the financial capital, because the goal of the financial capital, or the goal, is to use that financial capital to enhance the human capital. And by that I mean to allow the family members to do what it is that they want to do and what they do best, and to allow them to grow and prosper. And so how do you do that? And I think you want to center your goals around how you accomplish that, as opposed to simply what are you going to do with the family business, or what are you going to do with the family wealth. As an example, you could plan your estate planning simply for purposes of avoiding tax. And that will get you to a certain point, but does it really enable the human capital of the family to get where they want to be? Does it allow the person who's got some entrepreneurial spirit the ability to go out there and start his or her own business and prosper with that? Does it enable somebody else who maybe wants to do something different? Maybe they're an artist that wants to open up an art studio, and does it enable them to do that? So you've got to look at it from that standpoint, and also thinking in terms of how it gets divided as the estate passes on, and what's appropriate there. Is equal correct, or is it not correct? And in what circumstances is it correct, and what circumstances is it not correct? So I think all of those things have to be taken into account when you're thinking about what you have the opportunity to do right now. And like Eric said, this is a wonderful time to do some things because of the economy and what the tax code is allowing us to do right now. But you want to keep it in the context of what your goals are. So I'm probably getting a little long-winded here on this, so I'll try to finish it up. But I think that if you're going to do something, you want to do it and keep in mind the goals that you have. And if you don't have goals at this point, maybe the very first discussion you ought to have with your advisors and with family members is, what are our goals? What should they be? And let's define those, and then see what we can do with this to accomplish those goals and objectives.
I think that's an extremely important point, Jeff. And I do feel like oftentimes when it comes to estate planning, the tax cart does drive the horse.
Exactly.
And
sometimes too often.
Exactly.
Yeah.
Because we are all too much focused on the savings that are available from all these beautiful tools. But getting to that, to the extent that you make your goal, you set your goals and you determine that planning is appropriate, there are some really attractive ways and some good vehicles that you can use to deal with that.
Sure. Yeah, so let's go over some of them, and we'll talk about some strategies that we can use over the next few months and hopefully further into the future.
Yeah, I'm not going to spend a tremendous amount of time going through all of these in depth. I just kind of wanted to present that there are a number of different options to consider. Some are as simple as an intra-family installment sale or a private annuity where there's an actual purchase that's structured, perhaps at a discount, perhaps not. These are both very attractive right now, again, due to the low interest rates that are available. The grantor retained annuity trust is probably kind of one of the real hot ticket items that we see a lot of estates taking advantage of, and these are it's a very useful tool. It essentially involves transferring assets to a trust for a period of time. The trust is designed in some way to be defective in that it will still be taxable to the person who contributed the assets to the trust. This is also beneficial from an estate planning purpose in that the transferor pays the estate tax, or pays the gift tax, right? Excuse me, the income tax, further diminishing their own estate for the benefit of the future beneficiaries. A cash amount, annuity amount, or a unit trust amount is paid out to the individual every year that provides them some income or provides them some assets. And the main goal with this annuity trust is generally to move appreciation out and transfer the assets at the end of the term to the beneficiaries.
And I think the whole idea is, clearly these are strategies that involve more than just a simple gift to a lower generation. I would agree with Eric, the GRATs, the Grantor Retained Annuity Trust or Retained Interest Trust, are probably the most common that we see today, because typically with the low interest rates, you're basically contributing something, and typically for a short term, so there's no gift tax to the grantor or donor, and basically you're able to get a market rate of return that's above the applicable federal rate, and it's this excess that is really gifted tax-free, because the assets at the expiration of the trust term revert back to the grantor. This is really in the sights of Congress, and in the 2010 activity, there were discussions about having these being a minimum 10-year term. Right now, they can be as little short as a year, 2 years.
2 years, yeah.
The other thing is that as far as these intentionally defective trusts, where the grantor basically is deemed the income tax owner of the assets, that payment by the grantor of the income tax really gives the ultimate beneficiaries of the trust a much greater return on their investment assets, and if properly structured, that trust is not includable in the estate of the grantor. So it's a win-win, and who knows what will happen. The other thing that we've seen over the years is the charitable lead annuity trust, which basically permits the gifting of assets into a trust, and the charity receives the income from that trust for a term, and then at the expiration of the term, those assets revert to the heirs. And in essence, it's like, I'm going to give you $1 in 20 years. What's the gift tax value of that dollar? And it's pretty low. So I think the LLCs have been incredibly popular. There have been some really hard tax decisions, tax court decisions that have perhaps put them a little bit more in the sights of the IRS, but they're still a valuable tool.
Well, you know, you're right, Jay, that there's been a number of rulings that have kind of diminished the ability to use the discounts that are associated for marketability and minority interest associated with the family LLCs and the family limited partnerships. But I do think, even from a non-tax perspective, in terms of the management of the assets, these are still very attractive, particularly to deal with a lot of those management issues.
Well, let's, at the risk of getting too bogged down, I would like to get a little bit more on maybe Eric can walk us through an example of a grantor retained annuity trust, and especially just because the AFR rates are so low right now that it's really a great strategy now, and you'll see through this example how much really can be gifted out tax-free.
Right. Now, and my example here is a little bit different than maybe the way that we typically see the GRAT, in that I have designed this example that we do actually have a taxable gift that is included in this GRAT transfer. But I'm going to show here really how you're going to be able to, using this vehicle, to really maximize the value of that $5 million exemption using the GRAT tool. So in our example, we have a father who's age 60 who holds $8 million worth of stock that currently pays around a 5% dividend. The dad establishes a GRAT with a 10-year term and transfers the stock to the GRAT for the benefit of his 2 children. Now, during the trust is designed so that during the 10-year period, the trust will pay a $400,000 annuity each year to the father. Now, given the calculations based on the applicable federal rate, the value of the gift is going to be the remainder interest. In other words, what the remainder beneficiaries will receive at the end of the trust term. Based on the current rates, the value of this gift will be around $4,490,000. But now, assuming that we have that consistent 5% dividend, and let's even apply a modest annual appreciation of around 3%, the value of the remainder interest that will be transferred to the children at the end of the 10-year term, given the facts in this example, would be approximately $11.6 million. So I think you can see how, using this type of a tool, we're able to really maximize the value of the $5 million exemption to get a much larger pool of assets out of the estate.
And even if you wind up with a lesser growth assumption, I mean, it's still significant.
Exactly.
I mean, basically, you've gotten the $4,500,000 worth of the remainder assets and the commencement of the gift out of the estate.
Exactly.
And then, if you have any growth at all, you have just leveraged up the value of that exemption. And truly, in this scenario, which in a more normal economic period would be a very reasonable assumption.
Exactly.
We've got a good chart on the next slide that shows the recent trend in the AFR, and I think it's pretty clear, you know, where these opportunities are coming from with the rates that they're mandating right now.
Yeah, and I think that's what, for me, where this is really telling. Now, I want to point out that most of the actuarial calculations that are mandated under IRS law are kind of geared off of this midterm rate, which typically these valuation rates are 120% of the midterm rate. And right now, the midterm rate sits around 1%. So, I mean, you can see even since 2010, which at 2010 we were already looking at, you know, generally pretty low rates. You can see since then it has dramatically dropped. But you know, I want to make an example and kind of go back to our earlier example and show you the change that you know, the fluctuation in this rate would have, and why really it's so valuable to consider this gift as a perfect time to be accomplished. Assuming the same facts as our previous example, a 2% increase in the midterm AFR, and as you can see from our chart, it's not unrealistic to say that within the next year or so that we could see a 2% increase, because we've gone from, you know, roughly 3% of the midterm rate in the beginning of 2000 or late 2010 to where we are today. A 2% increase in the AFR would essentially increase the value of that gift by 7.5%. So we would go from a taxable gift of $4.4 million to roughly 4.8. So you can see those fluctuations in that interest rate, and it further demonstrates why now is such a good time, and we really need to be considering the opportunity. I think it's also, you know, we'll go back to this chart for a moment, and you can see, that the AFR is still is relatively low, and it's also beneficial not only from an actuarial standpoint, but to the extent that you want to make gifts or partial gifts and partial sales funded with loans between family members. The AFR is the minimum rate that we would have to apply, and you can see we can basically make zero interest loans and still be within the AFR. I mean, the short-term rate, which would be applicable for transactions less than a year, is currently it's around 2.2%. The midterm rate, which is going to apply between 3 and 10-year loans, is going to be around 1%, and the long-term rate, which applies to anything transaction over 10 years, is still very low. Pardon me, about 3%.
Mm-hmm. Yeah.
Well, I think that certainly this argues for at least consideration where you want to leverage the gifts. It may be that we have a bit more time to take advantage of these lower rates based upon recent actions by the Federal Reserve, but we don't know what the tax law is going to be either. So sooner rather than later, if this is something that you're interested in.
So we've got these tools, these strategies. Some of them are fairly complex. Should we all run to our attorneys tomorrow and try to do something before year end?
Well, I don't think that any attorney wants to see you on December 20th to start planning for the year end, but I think it's worth a conversation.
I would agree. And even if you don't, I mean, given the fact that we potentially face uncertainty, you know, we still have time to put some scenarios on the table. It may be that even if you don't push the button and make the gift final until December the 31st, you may want to certainly have a contingency plan in place, because these transactions don't occur overnight. They involve some planning. Certainly, hopefully, if it's done properly, not only considering the design of the instrument, but also of the goals and the objectives that drive the decision.
Exactly, and I was just thinking about that because I think you have to be really careful to not upset the apple cart, so to speak, with your family and your family business. And let me just talk about a couple of different situations. Let's say that you're in a position where you've got a family who has the father or the mother who runs the business, and they have 3 children, and 2 of whom are actively involved in the business and 1 of whom is not. And there are questions of how we transfer the business to the children and who do we transfer the business to, who gets what, and then looking at the children in terms of what it is that they want and what their expectations are. And if you've already gone through that whole process with the family and decided how that's going to work, then it's pretty easy to go forward right now. If you haven't gone through that process and had the discussions and had the communication, then it certainly is a little more problematic because you're liable to go into this process without properly considering the dynamics that are involved there, and may well you might not make tax mistakes. You might do some really great things there, but you might make some mistakes that upset the equilibrium of the family in very, very significant ways, and that's one of the things that you want to avoid. The other circumstance might be where you've got, let's say that you've gone to the next generation, and you're dealing with children of children now. We've got, say we've got a couple of people involved in the business, and their children are now coming up and getting ready to join the business, and they're thinking about how they might transfer that. And again, you're dealing with who's going to get what, but you're also now dealing with let's say we've got 2 people who are involved in the business and have the stock, and who's going to get what and how are they going to transfer it. And again, if they're not talking to each other about what their plans are with their families and how that's going to work and how the family business is then going to evolve, then rushing into it is also going to be a bit problematic at the family level. So I think you've got to be very, very careful with what you do. And again, it comes back to it, geez, if you've got your goals and objectives already defined and you've gone through that process, you're in wonderful shape. So if you haven't, you really need to consider that because, again, you can do these great things for estate planning purposes, but as I said before, the last thing that you want to do is upset that family equilibrium that you've established and worked. You've worked your whole life to get there, and you want that to continue. So I think that's a big consideration right now too.
So it sounds like the general theme is plan ahead, have your overall plan in place, and then we have these tax tools to make them happen that we should probably be pretty prepared over the next 3 months. It may not be the end of the world on December 31st, but some changes might happen.
Jeff, I was curious what your opinion would be. From my perspective, it's so important, I think, particularly for the family business to consider these issues and consider the individual's estate plan, because this estate tax really can pose a real strategic threat to a business.
Yes, it can. And I think that that's something that you really want to think clearly about. Obviously, part of it might be is the family business the only asset, and what kind of problems does that present when you are faced with an estate tax and you've got to come up with money, et cetera. And how do you plan for that ahead of time so that that's not an issue? Because in many, many cases, not only are families involved in the business, they're dependent upon the business. It is the only thing that they have, and even that may get passed down from generation to generation as well, so that while they haven't been able to or been able to set aside anything to build other family wealth, and oftentimes the other family wealth might be in something that's more liquid so that they have the ability to deal with estate taxes with that and still pass on the family business. If they haven't done that, then this does become a problem. So the estate planning and gifting becomes even more paramount in that situation. And if you do that properly, you can avoid a lot of those issues. So from a strategic standpoint, in terms of keeping that family business, And that may be, quite frankly, the most important thing to that family. Simply because, not only because it's providing them with their livelihood, but for other reasons as well, standing in the community, et cetera, ability to do philanthropy, those kinds of things as well. So it's critically important to the continuation of that family that it continue to exist. And so figuring that out well ahead of time and planning on that, not as the older generation is getting into their 70s and 80s, but as the older generation is in their 40s, 50s, 60s, beginning to think about that and formulate those plans about how that's going to take place, I think is critical.
And I think, this becomes even more important and more significant as you see a family business that passes on to further generations. As the ownership becomes more dispersed, it really becomes extremely important for there to be a line of communication between the business and the shareholders so that everyone understands what the expectations and what the potential obligations are that come along with that stock ownership.
You get into questions of how much freedom do the individual family members have with that stock, and how much control does the company have, and how it really comes down to a question of how important is that company to the entire family, and that almost kind of might determine what you might do and where you might go. Every family is different, so you can't. There's no cookie-cutter approach to that. And you have to recognize the differences from one family to the next, but that's a good point too, because you can't allow one or the other to really dictate. It has to be a blend of what's best for the individual family members, what's best for the business, and how do you get there. And sometimes getting there is extremely difficult, and sometimes getting there is impossible, and it can't happen. You've got to go one way or the other, and that leaves somebody out in the cold, or that leaves the family business not in the place that some people want it to be. I know I'm kind of talking in generalities there, but you can't really talk in a whole lot of specifics there, because again, every one of them is different.
Exactly.
I think before we answer this question that's on the slide, which I'm sure everyone's just dying to know the answer to, I'd like to ask a question of you guys from the other side, which is, what I'm hearing from clients is, I've got assets, it's more than $1 million, it may be more or less than $5 million. I want to take advantage of these opportunities to give, but I'm worried about the preservation of my own wealth. Are there strategies or general recommendations that you would point people towards in the next couple of months to say, well, we may not think it's likely to go all the way back down to $1 million, but here's some tools that you can use?
I guess the way that I look at it is that, just as Jeff discussed it with the business, if you're thinking about the individual, it's really what strengthens the family, what's in the best interest of the family on a long-term basis. The other issue that you have today is that there's a lot of litigation, there are a lot of bad marriages, people can have adverse business outcomes. I think the lesson of the financial crisis, at least my experience with the clients that I have, is truly people that thought that they were pretty well set up with their asset base and so forth, found out that maybe they weren't. The financial outcomes could be so adverse, and that's before you even had any other business challenges, divorces, or maybe special circumstances, children, something like that. So I think what you have to do is really take, the older generation has to evaluate really where their family is in this time, and it's trying to look in their crystal ball and trying to attempt to discern which are the stronger and more capable family members, and then how to protect the assets best for not only those children, but the children that probably have a little greater need or may not participate in the family business. And whereas I think that there has been a tendency to make just gifts outright in the past, and probably that's the vast majority of the gifts that one traditionally sees, I think that there is more of an emphasis now to place the assets into a trust or a family limited partnership or something like that for these reasons. One is, while each family unit may have differing needs, and they all need their own asset base to meet those needs, the comment that I would make is collectively a family can oftentimes accomplish things in business or in philanthropy that might be even greater than they can individually. So structuring that ultimate asset transfer is important. The second thing that I would say is that when you place some of these assets in trust, for example, it's not to deny a benefit, it's designed to preserve a benefit, because you never know what can happen. And so all I can say is I think you ought to make it a priority to consider what is in the family's best interest, and then how do you protect that family going forward, whether it's the business or other family members or whatever. But these are methods that can enable a family to accomplish things by not having to pay the full freight and tax.
Right.
One point I just wanted to add to Jay, I think it's important for everyone to consider the long-term objectives of the family and the best needs of the family. But it's also, I think, where the traditional model has focused mainly on the person making the gift. I think we've shown that, and a lot of studies indicate that involving the heirs in that discussion is also a crucial element. And I think that may be something that sometimes planners fail to try and encourage people to do, is really to talk openly about these issues and communicate the thought process and have a real understanding about the objectives and the needs of the other family members. The other side of that is, don't diminish the value that an inter vivos gift or a lifetime gift can have, particularly if it's happens at a particular tipping point. Particularly with longevity so long now, people living in their 80s and 90s, oftentimes the heirs who are waiting on this benefit may be in their 50s before they inherit. So it's important to kind of consider and keep these lines of communication open and consider alternatives that, what opportunities are we missing if we don't make these funds available. So it's about a communication and about everyone kind of coming to the table together to openly understand what the issues and concerns are.
Eric, what you say is very true about I'll say the person who is currently, in charge, let's say, and their issues, and one of the biggest problems that we see is when that individual or those individuals make the decisions for everybody else, and that's when they seem to run into an awful lot of the problems without taking into consideration what other people's thoughts, ideas, needs, wants are from their perspective as opposed to perspective from up above. I think oftentimes what the older generation is looking for and what they're so afraid of is, if I give this away, how am I going to take care of myself, and how are we going to take care of ourselves? And there are strategies out there to make sure that they can accomplish both. And I think that if we can answer those questions for them, then they're going to have some peace of mind going forward. And that's part of what our job is to bring some of that peace of mind, because there's a real fear there. You're used to a certain lifestyle. You're used to doing this, that, and the other thing. You don't want to see that go away. How do I keep that if all of a sudden I've turned over my assets to my children, and they're, what are they going to do with them, and are they going to take care of them the way that I did, and are they going to take care of me? So how do we accomplish all of that? And I think that that's really important. So some of these things can be used to accomplish that, and I think that that's part of our goal today is to express that, and that can be done.
Okay. Well, without further ado, let's answer the question that's been up on the screen, and I would encourage you too, if you have any additional questions, to type them in, and we'll try to get to them before we run out of time. But let's run through this example here, because I think this is illuminating of the situation we find ourselves in today.
Yeah, we talked earlier about the uncertainty that exists over clawback, and you always are afraid in an atmosphere of uncertainty. It's like what you don't want to do is to make a decision now that's going to have some negative impact in the future, or you don't want to look back with regret and say, if I hadn't done that, I would have been in a much better situation. I think that given what we understand about the potential outcomes and what's likely to occur, even if we have a sunset situation where, and we're in the most negative interpretation of the law, I think we can demonstrate that it's still probably beneficial from a strictly estate tax perspective, from a dollar perspective, to consider making these gifts currently. The example I have here, we have an individual with a total net worth of approximately $6 million. They're considering a $5 million gift to their heirs in 2012. Now, assume that we have the 2010 provisions that come back into effect, and then the individual who makes this gift dies in 2013. So what are we looking at in terms of an estate tax impact with and without the 2012 gift? Okay, so in each of these situations, in the first column you can see that we have the 2013 death with a $1 million estate with a $5 million gift. Now, this tax is calculated at date of death using the date of the tax rates that were in effect as of the date of the gift in order to determine what the credit amount for gift taxes previously paid or implied would be. Now, it's important to understand that this tentative tax on the total estate is kind of a constructive calculation. It may not be the actual. It's based on the fiction that's implicit in the estate tax model. So given that situation, you can see we have a $1 million taxable estate, the adjusted taxable gifts of $5 million, so we have a sum of taxable estate gifts of $6 million. So the tentative tax on the total estate based on the 55%, on the $1 million exemption and the 55% rate would be $2,940,000. Using a date of gift, or the credit calculated as of the date of the gift, the lower rates that we have in place now, the credit would be approximately $660,000. We can go back to the unified credit amount of the $345,800, and we have an estate tax due in that situation of approximately $1,935,000. Now, clearly that exceeds the amount of the taxable estate, so here we have effectively clawed back some of that, or we've clawed that back into the estate. But you can see, comparing that, if we head to the final column where we make no gift, we're still looking at the same $2,940,000 of estate tax. We're still looking at the $345,000 unified credit, but now our estate tax bill has jumped over $660,000 from the $1.9 million to nearly $2.6 million. So you can see, even where that money is clawed back, we've still obtained a pretty substantial estate tax savings by making the current gift. Now, obviously, what we hope would happen if we were faced with this really bad situation of a sunset is that we would have the date of death valuation be used for that constructive calculation of the credit for gift tax. In that situation, you can see that you've made a huge benefit, and you've saved over $2 million worth of estate tax, because your estate tax due on that $1 million estate would only be around $550,000.
Well, it clearly shows that it's something to discuss, it's something to plan, and it's also something that we should all keep our eye upon.
Okay. I think we could probably go ahead and wrap up. We've talked a lot. I think the focus, again, has been on planning. We've got some time to go forward. And I just want to reiterate what Jeff, Jay, and Eric have said, all in different ways, but the idea that this is a good opportunity, there's no doubt. But let's not, don't jump into anything that you wouldn't otherwise want to do for non-tax reasons, just because you can save some money on taxes. That being said, the tools are out there and available for you to use.
And use this as an opportunity to kind of really start the dialogue. Even if you don't move forward with making a gift in 2012, we have an opportunity now. We have a really good excuse to bring all the parties to the table and really kind of start to formulate what we want to do, what we want to accomplish, and how we need to go about making that happen. Because in any financial, just as in any financial situation, time is your biggest ally.
That's right, and I think that's really the important thing, because for the planner, for the family's attorney, for the family accountants, and for other individuals, it almost becomes that you are the family mediator, you are the family psychotherapist, you are the family legal advisor in the case of the attorney, or the accounting advisor with respect to the accountants. But this time is your friend, and if nothing else, you get a conversation started. And it's critically important for those smaller estates as well, because there's less latitude if you make a planning error. And I think the final thing that I've seen in my years of practice, I think most families don't want their kids sitting around waiting for them to die. That sometimes the judicious use of some gifted assets can make a real difference in what the younger generation is to accomplish. And so I guess we'd probably like to leave you with that thought, and thank you for your time.
Everyone, thank you so much for attending. We will have a quick survey right at the end when you exit the webinar. We'd appreciate your feedback. And don't forget, we will have the presentation for download on our website. Thank you again, and have a great day.